You can legally live in one country, own property, send your kids to school, and still pay taxes in another country. This is not tax evasion. This is tax residency planning, and it's something governments openly allow. Most people think, if I live somewhere, I must pay taxes there. That's not always true. In most countries, taxes are based on tax residency, not nationality, not visas, and not where your Airbnb is. Tax residency usually depends on physical presence, often the famous 183-day rule, your center of life, and economic ties. If you control these correctly, you can legally separate where you live from where you're taxed. Let's consider a practical case. You live most of the year in France, but are officially tax resident in Portugal with foreign-sourced income. This can work, but only if Portugal clearly looks like your center of life. That means a registered address, health system registration, bank accounts, and actual presence, not just paperwork. If France sees your family there, your main home there, or your kids in French school, France can still claim you, even at 120 days. Real estate is the most misunderstood part. Can you own real estate in 2 countries and still avoid tax residency? Yes, legally, but how it's used matters more than ownership itself. Owning real estate in your tax residence country is safest and strongly supports tax residency. However, owning real estate in the country where you actually live is where people get caught. If the property is long-term, fully available to you, and used as a main home, many EU tax authorities will call it a permanent home. Safer structures include short-term leases, serviced apartments, hotels, or property owned but leased to third parties. Owning an investment property abroad is usually fine, but owning a ready-to-live-in family home is risky. If you remember one thing from this video, remember this. Children in local school equals tax residency risk. In many EU countries, children attending school for a full academic year is clear evidence of a family's center of life. What works better are international schools, short-term or rotating schooling, or boarding schools in the tax residence country. A high-risk scenario involves kids in public school, a long-term lease, and parents just visiting. This combination almost guarantees tax reclassification. Consider this example. Tax resident in UAE, living 6 to 7 months in Spain, kids in Spanish school, and a rented villa year-round. Spain can claim full tax residency, even without 183 days, because family, housing, and routine establish the center of life. A strong, defensible structure looks like this. One clear tax residence country, main home there, and health, banking, and administration there. Also, limited, explainable presence elsewhere, and no permanent family setup in a second country. You can live internationally, but your life must clearly point to one place. This is not about hiding. It's about structuring your life intentionally. Most problems start when people try to have everything everywhere. If you want more real examples, EU-specific strategies, and legal tax planning, subscribe and turn on notifications.